your portfolio is about to get destroyed. And the worst part? Millions of investors are pouring their life savings into AI stocks, convinced they're riding the next Amazon or Google to generational wealth. They're dead wrong, and I'm about to show you exactly why. Here's what nobody is telling you. The artificial intelligence bubble we're living through right now isn't just similar to the dot-com crash of 2000. It's following the exact same psychological playbook that Munger identified decades ago. The same playbook that wiped out fortunes, destroyed retirement accounts, and left an entire generation of investors financially devastated. And if you think you're safe because you're buying Nvidia or Microsoft instead of some random AI startup, you're making the same mistake that cost people everything 25 years ago. Charlie Munger died just months ago, but before he passed, he was watching this AI mania unfold with the same concerned expression he wore during every market bubble of his 99 years. He didn't need to understand the technical details of large language models or neural networks to recognize what was happening. He understood something far more important. Human nature never changes, and the psychology that drives bubbles is as predictable as gravity. Let me tell you what's really happening right now and why your financial future might depend on understanding this. Every day, I watch retail investors, people just like you, making decisions that will haunt them for decades. They're buying AI stocks at prices that would make Munger physically ill. They're convinced that this time is different, that traditional valuation metrics don't apply anymore, that we're witnessing the birth of a new economic era where old rules simply don't matter. Sound familiar? It should, because that's exactly what people said in 1999 about internet stocks. They said the same thing in 1929 about radio companies. They said it in the 1840s about railway stocks. And in every single case, the people who believed that story lost everything when reality finally caught up with fantasy. But here's what makes the AI bubble even more dangerous than those previous manias. The technology is actually revolutionary. The internet was real in 1999, and it did change everything, just not in the time frame or magnitude that investors expected. AI is real today, and it will transform our economy. But that doesn't mean the companies you're investing in will survive to see that transformation, let alone profit from it. Munger spent his entire career identifying this exact trap. He watched brilliant investors destroy themselves by confusing a legitimate technological revolution with a sound investment opportunity. He saw how people could be completely right about the technology and completely wrong about the timing, the business models, and most importantly, the valuations. And right now, I'm watching the exact same pattern play out on a scale that would terrify Munger. The numbers are staggering. Nvidia's market cap has grown by over $2 trillion in less than 2 years. Companies with no AI revenue are adding artificial intelligence to their business descriptions and watching their stock prices triple overnight. Venture capitalists are writing 9-figure checks to startups that haven't figured out how to turn their AI models into sustainable businesses. This isn't innovation. This is speculation dressed up as innovation. And the consequences are going to be catastrophic for anyone who doesn't recognize the difference. Here's the brutal truth that nobody wants to acknowledge. Most of the companies you think are going to benefit from the AI revolution will be bankrupt within 5 years. Not because AI isn't transformative. It absolutely is. But because being revolutionary and being profitable are two completely different things. The history of technology investing is littered with companies that created amazing innovations and delivered zero returns to their shareholders. Think about this for a moment. During the dot-com boom, everyone knew the internet was going to change everything. They were right. But Amazon fell 94% from its peak. Cisco, the backbone of the internet, dropped 86% and took 17 years just to get back to even. Pets.com, Webvan, eToys, companies with revolutionary business models and brilliant founders simply disappeared. The survivors weren't necessarily the best companies or the most innovative. They were the companies with the strongest balance sheets, the most conservative management, and the most realistic business models. They were the companies that could survive the inevitable period when hype gives way to fundamental analysis and profit margins matter more than growth projections. But here's what's keeping me awake at night. I'm seeing the same psychological patterns in today's AI investors that Munger documented throughout his career. The overconfidence, the selective reasoning, the assumption that recent performance predicts future results, the belief that this time really is different. Munger called this The Psychology of Human Misjudgment, and he considered it the most dangerous force in investing. He watched it destroy brilliant people who should have known better. He saw how easy it becomes to rationalize increasingly risky decisions when everyone around you is getting rich doing the same thing. And that's exactly what's happening right now with AI investments. People are abandoning fundamental analysis because momentum strategies have been working. They're ignoring valuation metrics because growth seems unlimited. They're borrowing money to buy stocks because missing out feels more painful than the risk of losing everything. If you've been feeling the pressure to jump into AI stocks, if you've been wondering whether you're missing the opportunity of a lifetime, wouldn't it be worth subscribing to understand exactly how Munger would analyze this situation and protect yourself from making the same mistakes that have destroyed fortunes throughout market history? The central question isn't whether artificial intelligence will revolutionize our economy. It absolutely will. The question is whether today's AI stock prices reflect that future reality, or whether we're witnessing the build-up to the most expensive lesson in market psychology that this generation has ever experienced. And based on everything Munger taught us about bubbles, euphoria, and human nature, I believe we're much closer to the latter than anyone wants to admit. The crash is coming. The only question is whether you'll be prepared for it, or whether you'll be another casualty in the wreckage of misplaced optimism and abandoned common sense. Now, before I tear apart the AI bubble and show you why Munger would be horrified by today's valuations, I need to be intellectually honest. There's a reason why some of the smartest investors in history are betting their reputations on artificial intelligence. There's a reason why pension funds, sovereign wealth funds, and the most conservative institutional money managers are allocating hundreds of billions to AI companies. And if I'm going to make the case that this is a bubble, I first need to acknowledge just how compelling the bull case really is. Because here's the thing, the AI optimists aren't delusional. They're looking at the same technological revolution that I am, and what they see is genuinely breathtaking. We're not talking about incremental improvements to existing systems. We're talking about machines that can write code, diagnose diseases, discover new materials, and solve complex problems that have stumped humanity for decades. And they're doing it at a speed and scale that was pure science fiction just 5 years ago. Let me walk you through their argument, because if you're going to survive what's coming, you need to understand exactly why so many brilliant people have convinced themselves that this time really is different. The foundation of the bull case starts with something that's undeniably true. Artificial intelligence is advancing exponentially, not linearly. ChatGPT went from 0 to 100 million users in 2 months. That's faster than any consumer technology in human history. But the adoption speed is just the beginning. The real story is what's happening under the hood. GPT-4 can already outperform human experts on medical licensing exams, bar exams, and advanced placement tests across multiple subjects. It can write sophisticated code, debug complex software, and even discover novel solutions to mathematical problems. And that's just the current generation. The models coming next year will make today's AI look like pocket calculators compared to supercomputers. The optimists point to something called Moore's Law for AI, and the numbers are staggering. The computational power used to train the most advanced AI models has been doubling every 6 months for the past decade. Not every year, every 6 months. This means that the AI systems we'll have in 2026 will be roughly 16 times more powerful than what we have today. By 2028, we're looking at systems that could be 256 times more capable. But raw computational power is only part of the story. The real breakthrough is what researchers call emergence, the phenomenon where AI systems suddenly develop capabilities that nobody programmed or expected. GPT-3 wasn't designed to solve math problems, but it learned to do calculus anyway. It wasn't trained to write poetry, but it can compose sonnets that rival human literature. These emergent abilities suggest that we're approaching what scientists call artificial general intelligence, machines that can match or exceed human performance across virtually every cognitive task. Now, if you're an investor looking at this trajectory, the implications are mind-boggling. We're potentially witnessing the birth of the first technology that can fully automate knowledge work. Not just manufacturing or routine tasks, but the high-value cognitive work that drives modern economies. Legal research, financial analysis, scientific discovery, creative design, strategic planning. All of it could be transformed by machines that never get tired, never make emotional decisions, and can process information at inhuman speeds. the productivity gains could be unprecedented. McKinsey estimates that AI could add $15 trillion to global GDP by 2030. $15 trillion. That's roughly equivalent to adding 2 entire U.S. economies to the world. If even half of that projection proves accurate, we're looking at the biggest economic transformation since the Industrial Revolution. And here's where the AI bulls make their strongest point. We've seen this pattern before, and the early skeptics were always wrong. When the internet emerged in the 1990s, traditional investors called it a fad. They said nobody would buy books online, that e-commerce would never replace physical retail, that digital advertising was worthless. They were catastrophically wrong about the long-term trajectory, even if they were temporarily right about the bubble. The same thing happened with mobile computing. In 2007, Steve Ballmer famously laughed at the iPhone, saying it would never gain significant market share because it didn't have a keyboard. Today, mobile computing is a multi-trillion-dollar industry that has transformed everything from banking to entertainment to social interaction. The AI optimists argue that we're living through a similar moment of technological inflection, and that today's skeptics will look just as foolish as the internet doubters of 1995 or the mobile computing critics of 2007. They point out that the companies building AI infrastructure today, NVIDIA, Microsoft, Google, Amazon, have actual revenue, actual profits, and actual business models that are already benefiting from AI adoption. Take NVIDIA as the perfect example. Their data center revenue has grown from $3 billion in 2020 to over $40 billion in 2024. That's not speculation. That's real companies paying real money for real AI capabilities that are generating measurable value. When major corporations are willing to spend millions on NVIDIA's chips, it's because those investments are paying off in improved efficiency, better products, and competitive advantages. But the bull case goes deeper than just the technology companies. AI is already transforming traditional industries in ways that create enormous economic value. In healthcare, AI diagnostic tools are identifying cancers earlier and more accurately than human doctors. In manufacturing, AI-powered predictive maintenance is reducing downtime and extending equipment life. In finance, algorithmic trading and risk management systems are generating billions in additional profits. The optimists see this early adoption as proof that AI isn't just a technological curiosity. It's becoming essential infrastructure for competitive businesses. And if AI becomes as fundamental to business operations as electricity or the internet, then the companies controlling that infrastructure will capture enormous value. Here's where the argument gets really compelling. Artificial intelligence has what economists call network effects and zero marginal cost scalability. Once you build an AI system, serving additional customers costs almost nothing. This creates the potential for winner-take-all markets where the dominant AI platforms capture massive market share and enjoy extraordinary profit margins. Think about how Google captured the search market, or how Amazon dominated e-commerce, or how Facebook controlled social media. The AI optimists believe we're seeing the emergence of similar platform monopolies, but in markets that could be orders of magnitude larger. If OpenAI becomes the dominant AI assistant, or if NVIDIA maintains its grip on AI hardware, or if Microsoft successfully integrates AI into its enterprise software, the resulting market positions could be worth trillions. And here's the kicker that keeps institutional investors awake at night: the fear of being left behind. No portfolio manager wants to be the person who missed the AI revolution because they were too conservative. No pension fund wants to explain to retirees why their fund underperformed because they avoided the defining technology trend of the decade. The FOMO is real, and it's justified by recent performance. NVIDIA shareholders have made 40 times their money in 5 years. Microsoft has added over $1 trillion in market cap since announcing its OpenAI partnership. Even smaller AI companies have delivered returns that make traditional value investing look quaint and outdated. The bulls argue that this isn't speculation. It's recognition of a fundamental shift in how value is created in the modern economy. They point out that the companies driving AI development have some of the strongest balance sheets, most talented management teams, and most defensible competitive positions in the global market. What do you think about this optimistic case? Are there specific AI applications or investments that you find particularly compelling? Or does something about this bull thesis make you uncomfortable? The AI optimists aren't wrong about the technology. They're not wrong about the potential. They're not even necessarily wrong about the long-term value creation. But there's something crucial missing from their analysis, something that Charlie Munger would have spotted immediately. And in the next act, I'm going to show you exactly what that missing piece is and why it changes everything about how we should think about AI investments. Now that I've laid out the most compelling bull case for AI, let me show you exactly what Charlie Munger would have said about every single argument I just presented. And I guarantee you, his response would have made even the most confident AI investor deeply uncomfortable. Munger had a gift for cutting through compelling narratives to expose the dangerous assumptions hiding underneath. He would have listened to that entire bull case, the exponential growth, the productivity projections, the network effects, and then asked one simple question that destroys the entire thesis. At what price? Because here's what the AI optimists conveniently ignore. Being right about the technology and being right about the investment are two completely different things. Munger understood this better than anyone. He lived through the radio bubble of the 1920s, where everyone was correct that radio would revolutionize entertainment and advertising. They were right about the technology. They were catastrophically wrong about the valuations. Let me walk you through exactly how Munger would dismantle the AI bubble, using the same mental models that made him one of the greatest investors in history. First, Munger would have immediately recognized what psychologists call availability bias in AI investing. The most recent and dramatic examples dominate our thinking. Yes, NVIDIA shareholders made 40 times their money. But how many investors are factoring in the thousands of AI startups that have already failed? How many remember that during the dot-com boom, for every Amazon that survived, there were hundreds of pets.com that didn't? Munger called this survivor bias, and he knew it was one of the most dangerous traps in investing. We hear about the AI success stories because they make headlines. We don't hear about the AI companies burning through venture capital with no path to profitability because failure doesn't generate clickbait. But here's where Munger's analysis gets really uncomfortable for AI investors. He would have immediately spotted the incentive structures driving this bubble, and they're absolutely toxic. Think about who's promoting AI investments most aggressively. Venture capitalists who need to raise new funds. Investment banks earning fees on AI IPOs. Tech CEOs whose compensation packages are tied to stock prices. Corporate consultants billing millions for AI transformation projects. NVIDIA executives whose personal wealth depends on continued demand for their chips. Munger always said, "Show me the incentive and I'll show you the outcome." The incentives right now are aligned to promote AI investments regardless of their fundamental value. Everyone in the ecosystem gets paid for growth and hype, not for sustainable returns to end investors. And here's the kicker that would have made Munger's blood boil. Most AI companies today are valued based on total addressable market projections rather than actual business fundamentals. They're essentially asking investors to pay today's prices for tomorrow's promises, with no margin of safety if those promises don't materialize on schedule. Munger would have recognized this immediately as what he called big idea syndrome, the dangerous tendency to extrapolate exciting possibilities into inevitable outcomes. Yes, AI could add 15 trillion to global GDP, but could is not will. And even if it does happen, that doesn't mean today's AI companies will be the ones capturing that value. Let me give you a thought experiment that Munger might have used to illustrate this point. Imagine you could travel back to 1845 and invest in the railway bubble. You would have been absolutely correct that railways would revolutionize transportation, commerce, and economic development. You would have been right about the transformative potential. But if you had invested in railway companies at bubble valuations, you would have lost everything, even though you were completely right about the technology. The problem wasn't the railways, it was the prices. Investors paid for perfection and received messy, expensive, highly competitive reality. Most railway companies went bankrupt. The ones that survived delivered mediocre returns for decades. The real winners were often the suppliers, the landowners, and the businesses that used railways as infrastructure rather than the railway companies themselves. Now apply that lesson to today's AI bubble. Even if AI does revolutionize the economy, why should we assume that today's AI companies, at today's valuations, will be the primary beneficiaries? History suggests that transformative technologies often benefit everyone except the companies that investors initially bet on. But Munger's critique would go much deeper than just valuation concerns. he would have been deeply skeptical of the psychological and social dynamics driving AI investment decisions. Consider this social proof element that's driving so much AI investing. When Goldman Sachs analysts recommend AI stocks, when Harvard Business School case studies celebrate AI disruption, when every major pension fund announces AI allocations, it creates a powerful consensus that becomes self-reinforcing. Munger called this groupthink, and he considered it one of the most dangerous forces in markets. The scariest part is how rational and sophisticated this groupthink appears. These aren't day traders following meme stocks. These are PhD economists, former Federal Reserve officials, Nobel Prize winners in finance, all convinced they're witnessing a new paradigm. But Munger knew that intelligence doesn't protect against psychological biases. In fact, smart people are often more susceptible because they're better at constructing rational-sounding justifications for emotional decisions. And here's where Munger would have identified the most dangerous element of the AI bubble: the confusion between technological progress and investment returns. Just because a technology is revolutionary doesn't mean it's profitable. Just because it's profitable doesn't mean it's profitable at current valuations. The internet was revolutionary. E-commerce was transformative. Cloud computing changed everything. But investors who bought those stories at peak valuations still lost fortunes. The technology delivered on its promise. The investment returns did not. Munger would have been particularly concerned about the narrative fallacy driving AI investments. Humans are wired to love stories, especially stories about technological progress and innovation. But markets don't care about narratives. They care about cash flows, competitive advantages, and sustainable business models. Most AI companies today are burning cash while pursuing growth. They're funded by investors who believe that growth today will translate into profits tomorrow. But Munger would have asked, where's the evidence that AI businesses have sustainable competitive advantages? Where's the proof that current losses will translate into future profits? Where's the margin of safety if growth slows or competition intensifies? Here's another mental model Munger would have applied: the base rate fallacy. AI optimists constantly compare artificial intelligence to previous technological revolutions like the internet or electricity. But they're cherry-picking the success stories while ignoring the base rate of technological bubbles throughout history. For every transformative technology that delivered on investor expectations, there are dozens that didn't. For every internet or mobile revolution, there are multiple examples of 3D printing bubbles, nanotechnology manias, biotech crashes, and clean energy disappointments. The base rate of revolutionary technologies delivering revolutionary investment returns is actually quite low. But perhaps Munger's most devastating critique would focus on something the AI bulls completely ignore: the competitive dynamics that inevitably emerge in successful markets. Right now, AI feels like a winner-take-all game where a few companies will dominate everything. But Munger knew that extraordinary profits always attract extraordinary competition. If AI really does offer the productivity gains and profit margins that optimists project, every major corporation, every tech giant, every venture-funded startup will pour resources into competing for those profits. The result isn't AI monopolies. It's AI competition so intense that most of the economic benefits flow to customers rather than shareholders. We're already seeing this play out. OpenAI faces competition from Google, Microsoft, Amazon, Meta, and dozens of well-funded startups. NVIDIA's chip dominance is being challenged by AMD, Intel, and custom silicon from every major tech company. The moats that AI companies claim to possess are being tested by some of the most aggressive competitors in business history. Munger would have recognized this pattern immediately. Early leaders in revolutionary technologies rarely maintain their advantages once the market matures and competition intensifies. The real winners are often the companies that enter later with better execution, stronger balance sheets, and more realistic valuations. If you're starting to question whether the AI revolution justifies current market prices, or if you're curious about how to apply Munger's skeptical framework to your own investment decisions, wouldn't it make sense to subscribe and learn how to protect yourself from the psychological traps that have destroyed fortunes throughout market history? The most dangerous part of the AI bubble isn't that people are wrong about the technology. It's that they're probably right about the technology, but catastrophically wrong about what that means for their portfolios. And as Charlie Munger would have reminded us, the difference between those two things is often the difference between building wealth and losing everything. After walking through both sides of this debate, I've come to a realization that Charlie Munger would have appreciated. The AI bubble isn't really about artificial intelligence at all. It's about something much deeper and more fundamental about human nature, and understanding this distinction might be the key to navigating what comes next. The real story here isn't whether AI will change the world. It absolutely will. The real story is why intelligent people repeatedly make the same mistakes when confronted with revolutionary change, and why markets consistently overshoot in both directions during periods of technological transformation. Munger spent decades studying this pattern, and what he discovered is profoundly unsettling. The very qualities that make people successful in stable environments, confidence, pattern recognition, the ability to extrapolate trends, become liabilities during periods of rapid change. The most successful investors, the most accomplished executives, the most credentialed analysts all fall victim to the same cognitive traps when faced with genuinely transformative technology. Here's what I think is really happening with the AI bubble and why it represents something both more dangerous and more predictable than most people realize. We're not just witnessing a technology bubble. We're witnessing the collision between exponential technological change and linear human psychology. Our brains evolved to handle gradual, predictable change in small social groups. We're not equipped to process exponential growth curves, network effects, or the second and third order consequences of revolutionary technologies. This creates a systematic bias toward either complete dismissal or total capitulation. We either reject new technologies entirely because they don't fit our existing mental models, or we embrace them with religious fervor because the implications are too vast to comprehend rationally. There's very little middle ground, and that's exactly where the investment opportunities and dangers lie. The AI optimists are making the classic mistake of confusing possibility with probability and timing with inevitability. Yes, AI will probably transform most industries, but probably over decades, not years, and probably in ways that are messier, more expensive, and more competitive than current projections assume. The gap between those two realities, what we hope will happen and what actually happens, is where fortunes are lost. But the AI skeptics are making an equally dangerous mistake. They're using historical analogies that might not apply to a technology that could genuinely be different. The internet analogy assumes that AI development will follow a predictable S-curve with manageable competition and reasonable profit margins. But what if AI really does exhibit the winner-take-all dynamics that optimists project? What if the competitive advantages really are sustainable this time? Munger would have recognized this uncertainty as exactly the kind of situation where the smartest strategy isn't to be right about the direction. It's to be prepared for multiple scenarios while maintaining the financial flexibility to survive being wrong. And here's where I think Munger's real wisdom becomes invaluable. He would have focused less on predicting the future of AI and more on identifying the companies and investment strategies most likely to survive regardless of how the AI revolution unfolds. The companies that will thrive through this transition won't necessarily be the ones with the best AI technology. They'll be the ones with the strongest balance sheets, the most diversified revenue streams, the most rational management teams, and the most conservative valuations. They'll be the companies that can invest in AI without betting their entire future on it working out exactly as planned. This is where the real opportunity lies, and it's hiding in plain sight. While everyone is debating whether to buy NVIDIA or OpenAI or the latest AI startup, the smart money is identifying companies that will benefit from AI adoption regardless of which specific platforms win, how quickly adoption happens, or whether current valuations prove justified. These are companies in boring industries that will use AI to improve efficiency without fundamentally changing their business models. Companies that sell infrastructure and services to AI companies without depending on any particular AI platform succeeding. Companies that have been consistently profitable through multiple technology cycles and will remain consistently profitable regardless of how the AI revolution unfolds. Munger always said that the best investments are often the ones that don't require you to be right about big, unpredictable changes in technology or society. They're businesses so fundamentally sound that they'll compound wealth even if you're completely wrong about the exciting stuff everyone else is debating. But there's a deeper lesson here that goes beyond just investment strategy. The AI bubble is revealing something important about how we make decisions under uncertainty, and those lessons apply far beyond financial markets. We're living through a period where the pace of technological change is accelerating faster than our ability to understand its implications. This creates enormous pressure to make binary choices, to be either all in or all out on technologies that could reshape civilization. But that binary thinking is exactly what creates bubbles and crashes in the first place. The wisest approach might be what Munger called intellectual humility, acknowledging that we don't know how AI will develop, which companies will succeed, or what the timeline will look like, while still positioning ourselves to benefit from the most likely outcomes and survive the most dangerous ones. This means maintaining diversification even when concentration seems more profitable. It means staying curious about new developments without abandoning the principles that have worked throughout market history. It means being excited about technological progress without confusing that excitement with investment analysis. Most importantly, it means recognizing that in periods of rapid change, the biggest risk isn't missing out on the next big thing. It's making irreversible decisions based on information that might prove completely wrong. The AI revolution is real, but so is the AI bubble. Both things can be true simultaneously, and investors who understand this paradox will have a huge advantage over those who insist on choosing sides. The future will probably be stranger and more wonderful than any of us can imagine, but it will also probably take longer and cost more than current projections assume. Charlie Munger didn't live to see how the AI story ends, but he gave us the intellectual tools to navigate it wisely. The question is whether we're humble enough to use them, even when doing so means missing out on the spectacular gains that everyone else seems to be achieving. As you think about your own approach to AI, technology investing, and navigating uncertainty in an era of rapid change, I'm curious, what aspects of this technological revolution do you find most exciting, and which ones keep you awake at night?